Hello, everyone. My name's Stuart McPhee. Welcome back to the latest Trade Zone presented by Eightcap. It's great to have your company, whether you are listening to me live on this Monday, the 17th of July, or listening on delay, watching on YouTube or some media, watching this after the fact. It's great to have your company. Thank you very much for joining me. As per my other sessions that we've had in the month of July, and remember, I am here again throughout this week and again next week as well. As I've done previously, I just want to start off with just a little bit of education, and then we'll go and have a look at the MT4 and look at some charts, and certainly apply some of the things that I'll talk about in this presentation. But this is the way I like to, just to give you a little bit of education as well to help you along this journey. So in this session today, this is a slide that I've already spoken about previously, but I cannot overstate the importance of this. And that is the importance of your trading plan. There's that sort of old adage that if you fail to plan, you are planning to fail. And I find it extraordinary how many people enter the market with no semblance of a trading plan, really don't know how they're going to do it. But I think, and I must admit, this was sort of me as well when I started out. I think when it comes down to it, we think, well, certainly we don't think of the idea of having a plan. And we're introduced to the idea of trading, and there's financial products and there's numbers and there's prices, and you can go two directions, you can buy and sell. And then when you think about it, that's all you need to do. You only need to decide whether to buy or sell. That's it. And it's easy to think, how difficult can that really be if that's all you got to do? So we certainly don't think about, managing risk, the psychology and how the markets are going to wreak havoc with your brain and your mindset and the like, and your, all those things going on in your brain. We don't think about that. We don't think about psychology, managing risk. We don't think about, developing a strategy, the importance of consistency and what have you. We never even think about that. All we think about is just going in gung ho. Wow, let's make lots of money, make it quick, and have a lot of fun doing this. And then normally we almost feels like getting hit by a bus when things don't work out that way and they don't go as easy as we expected. And we sort of start to think about, oh, maybe there's more to it than we thought. Anyway, coming back to this, I cannot overstate the importance of having a plan. The plan that you develop must resonate with you, must suit sit very comfortably with you, be right for you. And then once we have that, and I'm going to talk about this a little bit in this session in the next few minutes, how we actually develop that. Once we have that plan that we're comfortable with, is right for us and sits well with us, then we can implement that with the right attitude, with conviction, with consistency, with discipline, with patience, just with having the right mindset. So imperative that you develop a plan that's right for you, and then we put that into place. We implement that plan with the right mindset. And as I've mentioned previously, and I'll probably cover this in another session, we're going to address those 3 M's. Money management, or some people will say risk, managing of risk, the methodology or the trading system we use, the strategy we use, and I'm going to talk about that shortly, and the glue that keeps it all together, and that's the trading psychology. Now, what I want to talk about specifically today is where a lot of people focus their energy on early on, and that is how do we develop a set of rules that are going to help us get into trades. If I just come back one step, I'll talk about this another time. I'll talk about this in another session, but at its very basic level, your trading plan should answer 3 questions, just 3. Those 3 questions are, how do you get into a trade? How much money do you commit to that trade? And how do you get out? Say that again. How do you get in? How much? How do you get out? There are other things you can address, but at the very, very basic level, that's what your trading plan should cover, those 3 items. And a lot of people focus a lot of energy, a lot of effort, a lot of time early on working on that very first question. Under what conditions do we enter a trade? A lot of people rarely address questions 2 or 3, or if they do, it's at some point a lot further down the path. They've already lost a lot of money in that time before they get to that. But we certainly focus a lot of effort on under what conditions, how do we get into trades? Under what circumstances do we get into trades? So that's what I'm going to talk about here, and that is developing a strategy. How do we develop a set of rules that are going to allow us to get into trades? What I don't want you to do is to be looking at a chart like this and just looking at it and wondering what to do with it. And you might zoom in a little bit, you might zoom out a little bit, you might draw a few lines in place, put on another moving average, apply another indicator. You know what? You could be looking at this chart for 5 minutes. You could change the time frame, go down to 4 hour, hourly, 30-minute, whatever it might be. You could be looking at this for 5 minutes and still be no closer to making a decision on what you're going to do with it, whether you're going to buy it, you're going to sell it, or pass on it. Now, why can we look at this for 5 minutes and still have made no progress? And that's because we don't know what we are looking for. We are almost deep down hoping that if we look at this chart long enough, and if we draw a few lines or apply some indicators or tilt our head a little bit to the left or the right, we almost hope that something becomes obvious to us. Something pops out at us. Oh, there it is. There's the pattern I was looking for. There's a reason to trade it. Let's go ahead and now execute a trade. What we don't think about doing is developing a set of rules that we can apply with great consistency, because that's what traders do. That's what we do. That we have a set of rules we apply with consistency. So when we look at a chart, it doesn't take very long to work out whether this is a trading opportunity or not. But how do we get to that place? How do we get to that position of being able to look at a chart very quickly and determine whether we need to do something with it or not? This is a process that I don't think is taught very often. What you will hear taught is strategies. People all around the world for a long time now have got up and said, here is my strategy. And people love this. They eat that up. Absolutely love the idea that someone well-known, some influencer, someone of authority comes up and says, hey, here's my strategy. I'm going to teach it to you. People go, bananas. They get very, very excited about that. So they present a strategy to you as opposed to maybe teaching you how to develop your own. So they'll give you a strategy and then you'll go ahead and use it or not use it. And I'll talk about that particular idea in this as well. The first thing I think you need to do if you wish to develop your own strategy is the first thing is to look at price, look at data. In Australia, I love this word. In Australia, we'll say data. A lot of people in the rest of the world say data. So I'm going to use those words interchangeably. I'm going to say data, only because that's how I always say it. But when I'm talking about data or data, I'm typically referring to price. So what we're going to do is look at price. In other words, we're going to look at multiple charts of financial products that we are going to have an interest in trading. So, we work out what our trading universe is. I'm interested in trading indices, some commodities, currency pairs. Okay, let's go and have a look at those currency pairs and let's start looking at data. And from that, we're going to start to make observations. We're not going to make observations. Look at data, make observations. And the observations we're going to make is something like this. You may decide you will always want to trade reversals. You want to trade when price reverses at a key level and starts to head in the other direction. That's when you want to trade. So what we could do here is identify several reversals in the Australian dollar on a daily chart. Certainly very strong move down here, bouncing back up. Reversal here, potentially another one here, one more, down here, another one, down here, and another one. We have several reversals happening on a daily chart. I'll talk about periodicity in just a moment. On a daily chart, and we can now start to make observations. What we can start to do is go, with all of those reversals there, are there some common themes so far as the candlestick patterns, individual candlesticks, anything, volatility, anything? Are there some common themes? And what we can say, well, for this particular reversal here, we had a very strong up. Then we had not quite a doji candlestick, but certainly a candlestick representing indecision, followed up by a reversal a candlestick trading in the opposite direction, and then we had a flow on from that. So there's a really classic reversal pattern right there. Very strong candle, bit of a doji, not quite centered, but certainly a wide range with very little consensus change throughout that period. And again, and then a follow through by trading in the opposite direction. We didn't have any of those dojis here. We just had a trade in the other direction. Pretty strong reversal here. Down here, we've got some there's a good doji candlestick here, not quite here, and so forth. And what we're starting to do is piece together some common themes of what tends to happen at those reversals. Now, you may not have any interest in trading reversals. You may want to trade continuation patterns when price congests for a little while. Just change this periodicity for all argument's sake. You may want to find, period of congestion, a break of that congestion and a new trend. That's the way you may want to trade. So you may identify this period here, area of congestion where it's trading in quite a narrow range, moves to a X period high, reverses, retests, bounces off again. That may be your cue to initiate a trade in that particular case going long. So what we are doing is looking at price, making observations. And just because we're able to describe one instance of when price did what we want it to do, and we're able to sum up, we noticed that candlestick happened, it was followed by that, volatility dropped, hit a key level, which has established itself over the last week or two, did this, that candlestick there was less than half the range of the previous one, or that one there was double. And we're starting to piece together some observations on what tends to happen when these things reverse. If I have time, and I'll schedule it in perhaps in a session later on in the month, I have 6 candlestick patterns, and I don't mean individual candlesticks, I mean a collection, 1, 2, or 3, which are very, very effective reversal signals as an example. And if that's what you wanted to trade, these provide very, very effective indications of reversals. That's the sort of thing where we are making observations. And the key, once we've done all that, is to then define the rule on how we would trade those observations. So if we saw price reverse, here or here or here, obviously we want to trade short. And what we are basically saying is if we were watching this real time right now, watching this real time far right-hand edge of screen, and this was happening real right now, what would the rules need to be to provide that a signal to us for us to take that trade? Define those rules. Now, again, just because it works then doesn't mean it's going to sum up the previous instance of that, the next one, or all of them. It may not be a very effective one at all, but this is the process of learning sort of what works and what doesn't work. And having done this myself and spent a lot of time doing this, and this just sounds so obvious, but it's not obvious to people, the more you do this, you get a very good understanding of what tends to work and what tends to not work, because you're making all of these observations, you're defining rules. Once you've had those rules, let's go and test them. Let's validate them. Let's prove or disprove. There's trading software out there, MT4 is one of them, where you can actually go and test a set of rules and run it over a currency pair, a selection, period of time, and it can provide you a report on this is what happened. X trades, Y losses, V wins, percentage, gain, etc. You name it. It's all number crunching. It can spit out a lot of numbers. We're able to test which of these observations. Now, if you're one of those ones that goes, hey, John Smith, influencer, really powerful guy, clearly a really good trader. What proof there is, I don't know, but everyone says he's a great trader. He has his trading system. It costs only $49. Go ahead and buy it, right? And you see all the testimonials, including from his mum. As everyone thinks it's a really good trading system. Even if you were to go ahead and shortcut some of these steps and go and buy one, I would like to think you would still do the 4th step there. You would still go ahead and test and validate it and prove or disprove. And I'll make this point very seriously. And I've said this for many, many years to many people. At the end of the day, it's your money at risk, not mine. And I think your money deserves the utmost respect. It's your money, not mine. And I think before you put your money at risk, you would want to have some confidence. Won't be 100%, I can guarantee that. You'd want to have some level of confidence, though, that this has a chance of working. This is a system based on really good principles, good rules. I've seen it work plenty of times before. I've tested it. I'm prepared to put it at risk and see how it goes in the market. It's not my money, right? It's yours. So even if I was to say this is the best thing ever, I think you would still want to go through that process of testing it to prove or disprove. And then finally, we can then go ahead and perhaps put it into practice for real. There's conversations to be had on whether you paper trade or you trade for real, or you trade for real with a lot smaller amounts of money to get a feel for it. There's a whole lot of different conversations we can have about that. But this, in very simple terms, is the process I use, or I teach people in how to develop your own strategy, your own set of rules that you know works, not all the time, but gives you the right probability that you can put into place in the market for real and feel comfortable doing that. I just want to talk about one more thing quickly, and then we'll go and have a look at some charts, and that is time frame. Now, MT4 has its sort of range. Other platforms have less. Others have more different timeframes or periodicities, is what I refer to them as, to select. And it's really important to develop a strategy which is in the right time frame. And what I want you to do, and I'll finish on this and we'll go and look at some charts. What I want you to do is to visualize yourself in 12 months' time trading very, very well. Everything is just humming. Everything's just going so well. This is exactly the way you dreamt your trading to be. You're making money. You're just really comfortable with the way things are working. Visualize that and have a think about your profitable trades. How long do your typical average profitable trades go for? How long do they last based on this ideal trading style that you have developed? You should be able to fit yourself in to one of the items listed in the far right-hand column. You should be able to put yourself into one of these. Is it minutes to hours, hours to days, days to weeks, weeks to months, months to years? Everybody can put themselves into one of those. There's no right or wrong answer. It's what you want your trading to look like. I can tell you now for my currency trading, I am days to weeks. So with that, I've now categorized myself as a short-term trader. And the key point for me is if I'm a short-term trader, the most suitable charts for me to use for that trading style is say 1 hourly chart or hourly charts, 4-hour charts, or daily charts. What that also means is if I'm trading that sort of time frame, I really don't care what the 1-minute chart is doing, 5-minute, 10, 15. I really don't care. I'm not looking at that smaller time frame. Having said that, if I'm trading really short term, very, very short term, I'm probably not interested in the weekly chart either, and maybe not even the daily, although there's an argument to be made of how important that is. Anyway, enough on that. I just wanted to give you a quick overview about, developing a strategy. To me, this is a really important process. I don't know of anyone. I'm sure they're out there. I don't know a lot of people who teach this process. They're more probably interested in teaching a strategy. But I think ultimately you need to, you want to develop your own strategy and have confidence in that. Let's go and have a look at a few things, a few surprises. The euro is probably the number one surprise for me. I was talking about this last week, and I feel comfortable with what I said. I stand by what I said. Clearly that 110 level there was providing significant resistance, and you can just look at it as well as I can. How many times hit it there left of screen, but then repeatedly. And this is a daily chart. This is over the course of nearly a month. That's a long time in the currency world. A month. I've been talking for 20 minutes, right? This is a month where the euro has hit that $1.10, stuffed around there for a little while and then been sold off again. Had another go, stayed around repeatedly, trying to push through that level, just unable to get through, gets sold off, another run, sold off. But then eventually, here's the key, is how strongly it eventually got sold off. So you could picture here at $1.10, all those buyers all those bulls willing to push this through 110, and they're just belting their head up against the wall, and they just can't get through. And I don't know about you, but if you repeatedly are headbutting a wall, you get sick and tired of it pretty quick. You get a headache, you're not interested anymore, you lose interest. Well, that's what happens with buyers. They're really trying to push this through, and there's just a glut of supply we can't get through. You lose interest real quick. That demand, that want, that bullishness just dies off, and we see price reflect that. So when it comes back up here to $1.10 and gets sold off again, wow, that's a pretty significant level. And then when we see it do it again, form this doji. So we've had 3 reasonably strong days. See this doji? So it's hit $1.10 again within a few pips, give or take. Hit $1.10, been sold off. We now have a doji on the daily candlestick, on the daily chart. Doji represents indecision in the prevailing, indecision, therefore a weakness in the prevailing trend. The prevailing trend is up. We now have weakness in that trend. Everything here was pointing for this to get sold off again. Everything, I'll be the first to admit. Resistance, well and truly reinforced. And again, and here it is, here it is hitting it again, forming a classic reversal signal in the form of a doji candlestick, and it doesn't work out. That sums up trading sometimes, right? That's just a perfect example where probability-wise, that's just a classic setup for trading this short back down to that, whatever it is, 108, or sorry, 107.50 level, and it didn't work out. This is a significant push. This isn't another test where it's just breaking through like it did all those times there left of screen. This is a significant push where it didn't spend a lot of time coming back and having a think about it. It pushed up really, really high. It's its strongest day in a long time, probably equal this one. So it's its strongest day in, I would have to, in fact, it's probably a fraction bigger than that without measuring it. Its strongest day in, I'm going to say, months. That's how significant it is. And then it kept going the next day. So that's a significant push. And this isn't anymore where it's just got through, had a bit of a look above, $1.10, had a look, and then gets whacked by sellers pushing it back down again. This is a significant push. But then for it to continue on and have another range almost the same, probably 3/4 of the previous day, is really quite a significant move. And so now we're looking at terms of, what's that? We're looking back to, 18 months? Not quite, but maybe 16-month high is pretty significant. The unfortunate thing is now we have this sort of congestion back here, top left-hand of the screen, where we're looking around that 112.50, 113, 114 level, which put a lot of resistance in place and pushed the euro down strongly. The only caveat I'd make on that is the fact that it did happen 14 months ago. So, the longer these key levels, the longer ago they were, I was going to say degrade, they lose their significance. If all of that price was to have happened in the last 2 or 3 months, then it's very much a factor. If it happened 12 years ago, probably not so much. The fact that it happened early last year, really not that much of an issue. It is a little bit, don't get me wrong, but it's probably not as strong as has it just happened in the last few months or so. But what have we seen here? Really strong push, 6 green candles in a row, 2 of them pretty significant. Nice little doji again. So this is a good doji candlestick here. Not a very wide range, mind you. So it hasn't had a significant range like some of these. There's not probably that many big dojis here anyway, just in this screen here. But that's a pretty narrow range, but it is certainly a doji. It hasn't been able to keep pushing higher. It's pushed up a little bit higher, got sold off. And, you can understand why doji represents indecision, because it starts at one price, moves up, moves down, or vice versa, all back and forth all day. And at the end of the day, it ends up exactly where it started. So that's classic indecision. And that's a weakness in the prevailing trend. And the prevailing trend is clearly up. So, people at the end of today, people are not going to be jumping all over it to go and buy it. And we can see that what's happened in the early stages of this current candlestick where it hasn't kept pushing higher because there was enough sort of indecision back here. But having said that, if this was to roll over, this 110 is now likely to stand up as a level of support. We often say resistance, if broken, often becomes a level of support. There's reasons behind that. I can share that in another session. Resistance, if broken, often becomes support, and vice versa. Support, if broken, often becomes resistance. And again, there's a reason for that. And the reason actually all comes down to the interaction of the buyers and sellers. It comes down to human nature and what people are doing and thinking when they see those situations unfolding. Because as you know, a lot of these decisions are made by people, probably not as much as they used to be, but still a lot of these decisions are made by people like you and I. They may be in hold of a lot more money than you and I, but they're still making the decisions very much so. So yeah, that's the interesting thing with the euro right now is, complete surprise for it to break up, and with such venom, with such pizzazz. It really did put on quite a show to have moved as well as it did and then continue that. But we are just in that indecision. Wouldn't be at all surprised, and we'll check this again in 48 hours for that to just roll over now. And if it was to come back this far, and I'm not saying it will, but if it was, 110 would have support written all over it, where I think there'd be a glut of demand of people wanting to jump on that. We've seen something similar with the Australian dollar, where it also, returned to this key level, but similar to before. And I think in fact, I remember mentioning this last week, that if it was to break through, don't be at all surprised if it did something similar to this. So now we're looking at a level of around 69 cents. So we'll just make that. Should be, I blew that. That's 68 I've just put in. I'll do that again. Perhaps I'll do my glasses for that. 0.69 and 0.69. Obviously, the other one was both 0.68. But again, you can see, big push move through that 68 level, which previously had been a level of resistance. Just zoom out and you can see that back through this period here. Moves through, hits 69, probably almost to the pip, and rolls over again. And I did say it last week that if it was to break through that 68 cent, don't be at all surprised if it does perhaps have some issues with 69. And sure enough, it did. Didn't get as close, but got pretty close and has rolled over again. And, because 68 hasn't been resistance now for a little while, it was back here, and we've seen more 69 be the resistance level. I wouldn't be at all surprised if 68 didn't present an area of support, just like it didn't here. So different with the euro, 110 was the resistance, broken through. If it came back, I wouldn't be at all surprised if 110 provided that support. Because 68 had been the resistance, but it's actually broken through. It's actually failed here and hasn't bounced off the 68. That's significant. And in fact, when it's come back through, it's tried again. 68 automatically became resistance again for 2 days in a row, didn't it? So I wouldn't be at all surprised here if it, if it came back down where it is getting very close now. What is it? Only 6 or 7 pips away from 68. The 68 actually won't provide that support, just like it didn't here. And we're going to very easily, see it drop back down below 68, and all of a sudden the lid's been put back on again, and it tries to climb back up again. Oh, hang on, there's a lid there again. Damn. And we're sort of back in this congestion here between, 66 and 68, which of course it spent a fair amount of time this year. Whereas early Jan is back in here, so it spent a little bit of time, above 70, but for the most part this year between 66, 68, and it has extended a little bit, obviously, in more recent time back up to 69. So that's where I'm seeing with that. And then the British pound we spoke about this week being a little bit different to the euro in the sense that it didn't have that same sort of congestion at 110 for an extended period of time. It has maintained this very nice, slow, steady, but ongoing rise. And it continues to do that. So, look, this also, like the euro, is trading at what must be, close to 18-month highs, 16-month highs. But it's done it in a lot more gradual rise rather than the euro, which sort of climbed to 110-ish, met a lot of resistance there for months. This hasn't done that. It's been a little bit different, but similar, these nice key levels here, 128, 130. The fact that it has broken so strongly through 130, again, if that was to roll over again, I wouldn't be at all surprised. Euro finding support at 110. I wouldn't be at all surprised with the British pound finding support at 130. And both those examples, 110 and 130 are both examples of just beautiful round numbers, multiples of 10 cents. And much different to 109 or 108 or 107.50, 110, 130, big figures, nice round numbers. It just means a lot of people tend to, think about those numbers, congregate around there, make decisions based on that to buy or sell. And that's where we tend to see a glut of orders, whether they be buying or selling, but a glut of orders. And so if we're expecting, a bit of support at that level, we're likely to see a glut of support and demand at that level because it's a nice round number. Well, that's just a few charts we've got through. Look at the Australian dollar. I do want to look at gold and a few of the indices. Perhaps next time I will actually start with those. I won't go straight to those major pairs like I always do. I mean, it's probably just habit because I look at them myself when I look at charts. I go and look at some of those major pairs. What I'll do as a promise next time, I will start with some of the other things. I'll look at some of the indices. We'll look at some commodities and the like. But until that time, that is my time all of a sudden gone very, very quickly. For those who join me live, thank you very much for taking some time out of your day to do just that. Thanks again. Hope you've enjoyed that, got some food for thought, and I do look forward to speaking to you again when I come around and speak to you in 48 hours time again on Wednesday. Look forward to it. Until then, very good trading to you.